some of the highlights of the Barloworld Limited results for the year ended 30 September 2016. From a revenue perspective, our revenues were up 6% to 66 billion rand, and that translated into an improvement in our operating profits of some 4% to 4.1 billion rand. Our profits before non-operating and capital items were up 14%. And I think most pleasing was the very strong inflow of cash from operations. We saw an inflow this year of 7.8 billion rand compared to an inflow last year of 1.1 billion rand. And this has led to a very healthy balance sheet position at year end. If one looks at the group's profits after tax before associates, those were up 30%. And if you look at our headline earnings per share, they were up 3%, with a major difference between profit after tax and headline earnings per share growth being the drop-off in our income from associates, mainly as a result of a decline in profitability in our joint venture in the DRC as a result of one of our major customers there suspending mining activity following a slope failure at one of its major pits. If I give you a summary of the performance in our major operating divisions, Equipment Southern Africa suffered somewhat from the fourth consecutive year of a decline in mining activity in the country. But notwithstanding that, our operating margin held up well at 8.5%, and pleasingly, we saw a positive cash inflow of 3 billion this year compared to a utilization of 1.7 billion last year as a result of very focused working capital management. Our Russian business also had a record year as a result of strong deliveries into the open-cast gold mining industry, while our Spanish operation suffered somewhat from two inconclusive general election results, which caused some uncertainty in the business sector and some holding back on infrastructure projects. If I move on to automotive, we had a record year in our automotive operations. Our Avis car rental profits were strongly up as a result of both increases in volumes in terms of car rental days, as well as increases in rental revenue per day. Avis fleet was marginally down as a result of the non-renewal of the government of Lesotho contract. But if you remove that on a like-for-like basis, the balance of the business was up 7% year on year. Our motor retail operations suffered from a decline in new car sales in South Africa. However, overall operating profits were up 15% as a result of the contribution of the recent acquisitions, namely the two Mercedes-Benz dealerships which we acquired, and also Salvage Management and Disposals, or SMD, which performed in line with expectations. Logistics profits were up some 40% as a result of organic growth on new contracts awarded, and also the impact of the Smart Matter acquisition last year, as well as the acquisitions this year of KLL and a 51% stake in Aspen Logistics Services, which contributed in line with expectations and provide us with a platform for growth in the refrigerated transport segment. If one looks at the overall outlook for the group, I think we are seeing of late some recovery in commodity prices, and that has led to some early evidence of green shoots in the mining sector. And if those materialize through both new mine expansions and the replacement cycle kicking in on some of our major customers, that will benefit both our Equipment Southern Africa and Russian business. In Spain, they have finally formed a minority government, and that should lead to a removal of some of the uncertainty that was holding back investments in infrastructure by the construction companies. Our handling business should benefit from the BayWa joint venture, 50/50 JV, which we entered into post year end with a company which should provide us with a platform for agricultural growth in Southern Africa. Our automotive business will continue to face a challenging environment in terms of declining new vehicle sales. However, rent-a-car should still benefit from increasing inbound tourism and also a solid and robust used vehicle market. Logistics will benefit from a full year's contribution from the recent acquisitions. So on an overall basis, I think the group has got the right and clear strategic focus in each of its business units. I also think we have very strong market positions across the board. The strong cash inflows this year have meant that we have a very healthy and robust balance sheet, And that means as a group we're very well placed for both organic and acquisitive growth when the right opportunities arise into the future. I believe we have the right leadership teams in place in all of our businesses, and these things taken together mean that we are expecting another year of solid progress into 2017.